Mr. Sivaramakrishnan Chittor. He's whole-time director and CFO of Sai Life Sciences. He joins us right now on the show. Mr. Chittor, good having you. Thank you so much for taking the time out. I mean, if there is one company which is happy with FY26, it seems to be you, right? Because you had a fabulous start to FY26. You have strong capacity addition plans. Yes, the tariff situation, clarity around that might be welcome. But let's start with what is it that you are hearing from your end clients about the ordering pipeline and the outlook ahead, considering this whole tariff situation and the lack of clarity around it?
Well, I think, Neeraj, you put it rightly, right? We still are waiting for more clarity on the tariffs, but I think the broader conversation with respect to outsourcing hasn't changed. In fact, it has actually turned out much more, I would say, aggressive and better for the Indian CDMOs across the sector. And I think customers are looking at primarily diversification. And that's the theme that's driving a lot of the discussions. And that's one reason why we are adding CapEx, because India is behind China in terms of scale and capacity that China has put up over the last 10, 15 years. And for us to be meaningfully important or relevant in this space, we need to add those capacities and capabilities. And that's really what we're actually working on.
Very interesting. Okay. So as of now, would it be safe to assume that you are saying that clarity is amiss, but ordering activity and business is kind of going on as usual?
Yes, you're right. The broader understanding as we speak to pharma customers is, between India and China, there is tariffs on both countries. And, APIs constitute a very small portion of the overall cost structure for an NCE. So I think the impact that it could create for a pharma launching a new product will be minimal or negligible, is our understanding, given that the pharma conversations haven't changed over the last few months, even as we all wait for clarification on tariffs.
Mr. Chittor, Hiral on this side. So let's add this up. Now, you're talking about clarity, which is yet awaited when it comes to tariffs. To add to that, you're talking about capacity expansion, where you've recently completed phase 2 of the production block 11 at Bidar. And secondly, you've also opened a unit 4 in Bidar, which is dedicated to veterinary and API production. Now, currently, what is the kind of utilization that you're sitting on? And with this added capacity, what's the revenue recognition that you're expected to see in the next, say, 12 to 18 months?
Hiral, excellent question. I think while the clarity is still not emerged in terms of what the tariffs are, I think the broader sector movement and the conversations that we are seeing with large pharma indicates business coming into India. And from our perspective, we are seeing conversations that give us confidence to add additional capacity. As we had mentioned during the last earnings call, we had stated that we are at more than 70% capacity utilized, and then we added 100 KL capacity at the end of last quarter. Our next set of capacities will come in between mid and end of fiscal 27 from a manufacturing capacity perspective. This is what we had actually presented during the last earnings. And I think that, where it will be post this and what the earnings growth will be, I think what we have given to the market earlier is that we expect to do a 15 to 20% growth on an average over the next 3 to 5 years business. CDMO business is lumpy by nature. Some of these factors are outside the control of what CDMOs can do. So our growth, guidance that we've given earlier remains. We are talking about a 15 to 20% growth over the 3 to 5 years. We do not give projections for the next 12 to 18 months, but we believe conversations that we are hearing from pharma indicate a longer term move and shift to India. How much it will shift, what it will be at the end of 5 years or so, remains to be seen, depends on what India as a country or a CDMO sector can absorb.
So, Mr. Chittor, let me tie 2 questions because we are running short on time. One, how big is the veterinary opportunity versus the human pharma API opportunity? How big that business will be? And number two, when you're talking of growth as well from here on, what are you pegging it as compared to your, I mean, a CAGR of 25% is what you see in revenue, profits spectacular, and an EBITDA growth of 48%. Is that what will continue, or you think you will surpass those kind of numbers as well?
So, again, 15 to 20% overall longer term 3 to 5 year revenue growth being stated in the next 2 to 3 years. Our objective is to get to a 28 to 30% EBITDA. That's really what we are saying. We're not presenting separate growth by veterinary or by individual accounts of human health, but broadly, veterinary market, particularly companion animal segments, has started growing and is growing well. We already work with customers. Some of these customers are common customers, so the objective is to kind of use the ability to cross-sell and upsell to kind of get into the segment.
Got it, right. All right, Mr. Chittor. Great to speak to you as well. I think we should be having a longer conversation to understand, individual aspects as well, but that's the management of Sai Life Sciences.